How can socially conscious people like us, how can we fix our broken financial system that currently favors big banks, traditional corporations, and the super rich to a system that looks out for the well-being of us average American citizens without using politicians or regulations? This is the question we ask on the Crowd Effect podcast. I am your host, Paul Lovejoy, activist investment advisor at Stakeholder Enterprise. All right, a lot of talk about banking and banking failures, Silicon Valley Bank, and the overall soundness of our banking system. And there's a lot of worries for good reason. Now, there is a transfer of wealth that is going on, an increased concentration of wealth that is happening right now, and tens of billions of dollars are flowing out of these regional banks into big banks. People feel safer with these big banks, the same big banks that were bailed out in 2008. Now, in fact, they're bailing out a regional bank, and the reason isn't because of some altruism, but our current banking system is being built. Essentially, it's a house of cards, and the big banks are continuing to prop this up. Now, there's a lot of problems with putting your money into big banks. Uh, for example, I know people feel safer now with their money in big banks, but the problem is since 2000, the four major banks, which control half of all the U.S. banking assets, all the banking assets, half of all banking assets in the United States are controlled by four banks: JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. Now, these four banks have been responsible for 882 violations since 2000, totaling $167 billion in fines. Now, these banks are heavily regulated, mainly because they're for profit and they are constantly under scrutiny to increase their profits every quarter. Um, that's how it works. If you're not increasing your profits each quarter, then your share price of your stock will go down. So there's this enormous pressure to consistently grow your profits. And because of this pressure, uh, corners get cut, fraud happens, and these banking abuses happen. And so then we don't want that to happen anymore, so we regulate them some more, and then their fees to operate go up. It's more expensive to operate under these regulations. But we need the regulations because if we don't have them, then these banks will continue to defraud us and abuse us. So we're building this, that we're creating this system now of constantly putting more regulations, making it more expensive, and now there's more pressure to create profit, and it's getting tougher. Now, banks can't just raise interest rates to cover their expenses, so they come up with these creative ways to build their customers to excessive fees, and again, this creates more banking abuse, and so there's this vicious cycle of cutting corners, of abusing the customers, and then regulating, making it more expensive, and we still need to, these banks, they still need to increase their profits every quarter, or otherwise their shares will go down. And it's not getting any better. Uh, so here are some other things that are happening with our banking system, which will inevitably cause more financial crisis. So Silicon Valley Bank, um, they collapsed because of really one individual, the president, the chief executive of Silicon Valley Bank, and their board um, put up so much of their banking assets into these long-term bonds, government bonds, U.S. Treasury bonds, and uh, if you look at their interest rates, they're horrible. And they did this in 2019 during the or 2020, actually 2020 during the COVID pandemic, where they're all of a sudden flush with cash because tech companies were booming during the pandemic. And so they had all this cash. They threw it into Silicon Valley Bank. Um, and now they need to do something with their banking assets to increase their profits. And so they put it in these long term bonds at terrible interest rates. But they're thinking, well, it's safe at least. So then inflation hits, and all of a sudden, the inflation is easily outpacing the interest rates, um, this is a bad thing. If they have to sell these bonds, they're going to be um, they're going to have to sell them for far less than what they paid for because nobody wants a bond with a crappy interest rate right now, especially with such high inflation. So these banks are hoping that the tech Silicon Valley Bank is hoping that the tech sector stays strong. Well, guess what? It all of a sudden it's not. During the summer months or of 2022, leading up to the winter of 2022, tech companies started to sag and they started to withdraw their money out of Silicon Valley Bank. And guess what? The bank had to sell these bonds that they bought at that they had to sell at less than what they paid for, and they had to disclose that fact, and so it triggered a bank run, and they collapsed. Um, Now, this isn't just exclusive to regional banks. These large big banks, they are stuck with all kinds of loans that they're losing money on if they had to sell them. So think about all the billions, if not trillions of dollars these big banks have in mortgages. We're back to mortgages again. Now, they're not creating these derivatives or these bizarre type of investments that they're selling on Wall Street. They just have these loans on their books that are what 3%. Maybe you refinanced a home loan, or maybe you bought a home and you got a 3% loan. Hey, that's great. However, with inflation at 8%, this is not good for banks. And if there is a bank run and they have to sell these mortgages, it'll be 2008 all over again. So the big banks want to prop themselves up, saying, "Hey, we can bail out people," but meanwhile, they are set up on a house of cards, ready to collapse. And this is obviously a huge problem. This concentration of wealth. We put all of our money into a banking system that is basically for profit. Not basically, it is for profit, and they need to maximize their returns, constantly getting more profits every quarter in order to keep this system going. Okay. So this is where we are, and it's bad. It sounds bad, and it is bad. And they're going to try and do everything to pull the wool over your eyes and say nothing is wrong here. There's no one behind the curtain here. Please just go on with your day, watch your Netflix. Everything is fine. Um, but it's not. Everything is not fine. All right. We are in trouble, and we need to do things differently. We need to take a different perspective, completely different perspective. All right. First thing that we need to do is, instead of putting our money into this for-profit system that is constantly, we're having this cycle of regulation and cutting corners and more fees. We need to stop doing that and instead put our money into credit unions. And I'm not the first one who have said this, but there are a lot of advantages that credit unions have over big banks. First of all, credit unions are nonprofit. So anytime they make money uh, over their expenses, it's not called a profit, but their net income. They they don't have to invest it. They don't distribute it to shareholders. Instead, they pump it right back into the credit union, which does wonderful things for the credit union members, the people that have accounts there. It helps lower the loan costs, giving homeowners are able to borrow mortgages at a lower interest rate. It gives depositors to credit unions higher interest rates because they can afford to do this, and they can afford to also pay cover the deposits if people do take money out or are taking them out. They have an extra reserve of cash that banks just don't have. So this is a huge step. First, people, instead of transferring money into the big banks and increasing this concentration of wealth, instead put it into a credit union, which are usually smaller and community based. They understand the needs of a community, and they reflect this not only with their practices in their credit union. Helping out their members, giving oftentimes free financial counseling, um, uh, assistance when needed, and not these excessive fees that banks will charge. To see a banker, or there, or to get something notarized. They don't charge these same fees that banks have to, because they need to generate more profits to increase their quarterly statement. So credit unions, all right, that's just one thing. Another benefit of the credit union is that their board is elected by its members. So a for-profit bank, they're elected by their shareholders, and you don't have to have money in that bank to be a shareholder. You just have to buy a share. So there's a conflict of interest. All your If you're a for-profit shareholder at one of these big banks, you just want them to increase their quarterly profits, so you can increase your profits. And most of the people who own bank stocks are just regular retirees. It's not like they're greedy. They need this money for retirement. Um, so credit unions, their board is elected, and they're members of the community. And it creates an environment that looks out for the well-being of its members. Okay, another thing about banks. Um, I mentioned that you had this concentration of wealth of one guy making the decision. Well, again, you don't have that concentration of wealth with the credit unions. Not only that, when credit unions do fail, and they do fail from time to time, there isn't this worry because they don't trade on the stock market. And because they don't trade on the stock market, there's no trigger effect of a system wide worry. When a credit union goes under, then uh, it's just a one off. And it's sad when it happens, and the members, they are covered. They have insurance just like the banks, up to $250,000 as well. And so they do have this insurance that the credit unions have to pay into. And the Silicon Valley Bank, there was no taxpayer money involved because of the insurance. The FDIC covered it. and people got their deposits back. Now it's been $250,000 for a really long time. This insurance amount, but that that seems like that needs to change. It seems like this insurance amount needs to get uh, risen to another level, especially with the credit unions. And that's something that they can do down the future. And there's really smart people who care in the credit union community. Now there is another thing that we can do, and I will talk about it. And this will be an absolute game changer to really fix our broken financial system. And I'm going to talk about that in tomorrow's show. But in the meantime, my name is Paul Lovejoy. I am a crowd investor, and I see you are one too.